Hello world, my name is Zara. I'm a full stack web developer with a passion for investing. Today I would like to make a very quick video for beginners. So if you are an intermediate or advanced investor, this is probably not the video for you. But I would like to describe the difference between a balance sheet and an income statement and just talk about some of the very on the surface key points of what we're looking for. I want to keep this very simple, very quick, very easy to understand, and I'll try to use layman's terms if possible. So first of all, we have a balance sheet. And a balance sheet is basically just to see how much money the company has at the moment, or how much debt the company has at the moment. All we want to do is take a quick snapshot and see where it is in time at this one moment. So for an example, we have a company that sells shirts, let's say. And this company has a certain amount of cash on the books, they have a certain amount of debt on the books. So stuff like cash, buildings that they own, inventory, stuff like that, that would be considered assets. These things are worth something. So if they have $1 million in cash, that would be on the cash line, typically right at the top of the balance sheet. If they have $500,000 worth of shirts, that would be considered inventory. And if they have $3 million worth of buildings, then that would be under property. So cash and inventory would be considered short-term assets, and there can be other short-term assets. If you're interested, you can look into that. And stuff like buildings and maybe equipment that they own, that could be considered long-term assets, or fixed assets, I should say. So let's add all these up. We got $1 million in cash, we got $500,000 in shirts, we got $3 million worth of buildings. So let's say this company has $4.5 million worth of assets. In accounting, this would be on the good side of the balance sheet. This is the stuff that is actually worth something. You want your assets to be a lot. You want to have a lot of assets. So on the other side of the balance sheet, we have liabilities. Liabilities can be any number of things, and typically this is money that the company owes to other people. Stuff that would fall under the short-term liabilities category would be stuff like rent that is due. Now that is money that is known, and that is money that they owe, possibly to a landlord if they don't own some of the buildings. Sometimes companies own some of the buildings and rent out some of the other buildings. So that would be a short-term liability if they owe rent. An example of a long-term liability would be long-term debt. Now typically if you are a company, or if you're an investor in a company, you don't want to see that the company has a lot of long-term debt. This is usually big amounts of money that company owes to other people, and sometimes they borrow long-term debt for very good reasons, like they are buying a new building so that they can expand the company. And sometimes companies have long-term debt for very bad reasons. Maybe they wanted to buy more shares of their own company because they felt pressure from the stockholders, and it wasn't a very good time to buy. The stock ended up dropping anyway. But I'm going on and I'm rambling about this. Basically, liabilities are money that they owe to other people, like rent, and like money that they borrowed, like loans. So let's say this company has $2 million in liabilities. Then they had $4.5 million of assets. They have $2 million of liabilities. So we're going to subtract these two numbers. So 4.5 minus 2 leaves 2.5. What is that 2.5 called? $2.5 million of stockholders' equity, or shareholders' equity. This is something that we like to keep track of. We like to see that over time, year for year, a company has more and more shareholders' equity. This could be considered, to put it simply, if the company were to sell all the stuff that it has, sell the cash, sell the inventory, sell the buildings, and pay off all the debt that it has, how much would be left over? In this case, it's $2.5 million. So this company, you could say the book value of this company is $2.5 million. So those are the basics of a balance sheet. If you want to know further into this, please feel free to ask me any questions, because I love talking about it, and I study balance sheets every single day. There is more to learn, but this is just a basic video for beginners, so I won't go any further into balance sheets. Basically, you need to know that assets are good, liabilities are bad, subtract the two, and you have shareholders' equity, what is left. So, income statements I will try to do a very simple discussion on income statements, just like I did balance sheets. So an income statement shows how much sales and how much income a company has made. In most cases, it's like last quarter or last year, you can see the income statement. So just to run through a pretend income statement really quick, let's say a company has $5 million in sales. So let's say the shirt company sold $5 million worth of shirts. So that would be called revenue. Another word, sales. Another word, top line. That is the top line of the income statement. So when you hear people talk about top line growth, blah, 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 they're talking about revenue growth, sales growth, the number, the cash value of all the stuff that they sold. So this is called top line for a good reason, because it's right on the top line of the income statement. So after that, actually, we'll jump right down to the bottom, and then I'll tell you about some of the stuff in the middle. On the bottom could be called the bottom line, and that's called net income. After you take out all the expenses that the company has spent on different things, let's say they spend $2 million on the materials to make all the shirts, they spend $2 million on employee wages and advertising cost, they had a write-off for depreciation, they spent a little bit of money on interest, they spent some money on taxes. You can't get away from paying taxes if you're making money. So maybe their bottom line would be $400,000. So this company had $5 million of sales in their top line and $400,000 of income on the bottom line. So that would be the net income. And if you divide by the number of shares that the company has total, let's say it has 400,000 shares for some reason, just to pick a really easy number, then they have $400,000 in net income divided by 400,000 shares, which would mean each share that you own is entitled to $1 of income. So let's recap. We have the top line, which is revenue. We have the bottom line, which is net income. Now, what are some things that are in the middle of the income statement? We have cost of goods sold. So under revenue, we have $5 million worth of shirts, minus the cost of the goods sold, COGS, COGS. Let's say it costs $2 million for that. That means we have $3 million left. So out of this $3 million, we have to pay our employees, we have to pay for advertising and stuff like that. So that would be selling and administrative expenses. Let's say it's $2 million. And we would be left with $1 million of EBITDA, EBITDA. EBITDA is this $1 million. This is a common term in accounting, and basically what EBITDA stands for is earnings before interest, taxes, depreciation, amortization. So EBITDA is a common term. If you hear EBITDA, then you know that's the amount the company made after they spent money on all the materials for the clothing and after they paid all the employees and paid for advertising and stuff like that. So EBITDA, this is a very common number. If you're looking at a company, their EBITDA for 2015, then their EBITDA for 2016, then their EBITDA for 2017, and it's growing, 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 that is a very good sign. It means either their sales are going up and their costs are not going up too much. So you want the EBITDA to be growing. So after that, on the following lines are the I, T, D, and A of EBITDA. You have the interest that comes out, you have the taxes that come out, you have the depreciation, which is an accounting thing, it's a write-off for the value of buildings and stuff like that, and then you have amortization, which comes off. So you have those four lines, and after you pay your interest, your taxes, after you write off the depreciation, write off the amortization, you are left with the net income on the bottom. So I tried to keep this simple. I hope this helps. Just remember, it's good for a company to have good, strong top line growth, revenue growth. You want them to be growing sales and becoming a bigger company in the future. And you want them to have good bottom line growth. You don't want their expenses to be so much that it is killing them. And even though they have good top line growth, they're not making more and more money every year. So we got top line growth, we got bottom line growth, income statement, we have the balance sheet. Now we know everything. If you're more interested, please message me. And again, thank you for subscribing. Bye.